Everybody, it's Craig Moser. Hope you're having a good April 2022. Wanted to have a few minutes with you and talk about what's happening in the mad world of investments today. Before I get into a bunch of charts and things, there's a lot going on. There is a lot more volatility. There is a lot more uncertainty than we have seen over the last 5 or 6 years. Even with COVID, which was unknown, there was so much stimulus money and money pumped into our economic system that we've really not experienced true volatility from a overpriced situation or from what's getting ready to happen here with an increase from inflation. Interest rates due to inflation. So as we're looking at these charts, understand that when you look back, for example, to the 90s and ask a question, how hard was it to get an average return of 7%? It wasn't very hard. Why? Because we had fairly significant interest rates to buy bonds with, and that gave us a buoy for returns. As we have shifted over time, us, investors have had to shift more to risk, meaning that as we have had to push our portfolios harder to get a better return, what you're seeing is more highs and lows. You're seeing more buybacks from corporations, which makes it sort of a skewed set of numbers rather than just pure earnings. So as we're looking into the first part of what I'm talking about here, just understand that we're in a situation to where it's not a normal environment that, it's just, okay, stocks are up or down. There's more going on than the typical world that we've seen in the past. So as we look over the past 1 year, this sketchy up and down red and green thing is what most people look at and say the market, S&P 500 index, which is 500 of the largest companies. It's market weighted, so the bigger companies get the higher percentage. It's market weighted, and this is sort of what's happened over the last 12 months. So you're seeing a decline, which was about 14% from the first of the year, a recovery. So, okay, it's moved back up. But once again, we're seeing ebbs and flows. We're not seeing a consistent line and a steady return. I'm going to push out a 5-year number here. And let's just look at this for a minute. Now, doesn't this look a little odd to you? To me, you're seeing a market that went up. Okay, so that was 2018, what I'm pointing to right here. We had this lovely thing when they dropped tax rates for corporations, brought some money back to the United States, and then we went into trade wars. We went into whatever that was that happened right there at the end of 2018. I mean, I really can't explain what that was. And then we see a pretty nice run, and then we see COVID. All of this has been due to an additional, in my opinion, $4.2 trillion worth of cash infusion into our economic system. So when you look at a chart, and I don't know, I look at charts all the time, right there, sort of your run, if you will. So we're not that far off of where markets probably would have been without all of this extra cash infusion. But when you see a market that was up here, let's just use your money and say you had the S&P 500 and you had $1 million, you lost 140 some thousand bucks right there. Now, has it recovered back up? It's certainly trying to. And my discussion today is how come? Why did this stock market that we invest our money in, why did it just bounce right back up? And to me, again, opinion is that we have a whole lot of money in search of some place to go. If you buy something that pays an interest rate, we're not there yet, meaning that the stock market is still the best game in town if we're going to use it for potential return. If you put your money in a CD, if you buy a 10-year US Treasury, you're kind of not making any money. And now with interest rates starting to go up, the actual bond prices that we see, which I'll show you in just a minute, are actually going down. So my opinion, take that for what it's worth, is that this stock market is rallying not because it's in great shape and everything's super good, but instead it's rallying because there's no other place to go. Does that help? It might not. So this is a 2-year window, what I switched to. So you can see we had a pretty nice run over the last 2 years, and now we're starting to see a couple of chinks in the armor. All right, so if we switch straight to bonds, so I've gone S&P 500, which is large US, and now I'm switching to our bond aggregate index, and I use AGG as my example. This is a 2-year look at the price of bonds in general. So this takes in corporates, high yields, and treasuries in its mix. So what you're seeing here is a market that has sold off their bond prices in anticipation of an increase in interest rates. So the whole bond market is assumed, if we use a trailing 12 percentage for interest payments, to yield about 1.82%. So as bond percentages go up, as interest rates are being increased, this should continue to go down. You're hearing comments like we're almost at an inversion in the yield curve and those types of things. That's usually indicative of long yields and short being about the same. So what's the advantage of buying a longer maturity bond if you can get the same thing on the short end of the curve, that type of thing? It's not a discussion that we can have today, but nonetheless, the usual defender that people use in their portfolios is or should be bonds. And guess what? They're not helping at all over the last 2 years. The prices of your bonds have declined, most recently in part due to the fact that they think interest rates are going to be increased. And so that should probably go down a little further before it's all over. Not great. You know, it's not the end of the world either. It's not as volatile as stocks, but it's not giving you any help like it did in the past. If we look overseas and say, okay, what's happening across the pond there in Europe, Australia, Japan, Canada, the index that maps that most easily is the EAFE index. And you can see again, not really anything great happening. So from a chart eye, you see lower highs. So to me, that's a market that every time it goes down, the people that buy the dips right here, buy the dip, buy the dip, buy the dip, buy the dip, buy the dip. But that dip is going further down each time, and the high that it rallies to is not increasing. Whereas if you look over on the other side, buy the dip, buy the dip, buy the dip, buy the dip, and you actually were rewarded for that effort. You know, no investment strategy works all the time. You need more than one thing happening in your portfolio. If we look at emerging markets, now the big three in the emerging markets are Russia, India, China. You wouldn't expect those to be killing it right now with what's happening with Russia, especially. So, you know, once again, as we look, and maybe your eye gets trained a little bit from what I'm saying, buy the dip worked as the market rallied, but now from here, lower highs every time it's occurring. And so that's not a great market pattern, chart pattern for you. So are we sliding into a recession? I don't know. I truly don't know if that's going to happen anytime soon, but I believe we should be. And so the things that have moved the needle have been so much cash being printed. There's been a lot of money injected to our economic system. A lot of these companies, rather than expanding their business, have bought back their own stock shares to reduce how much is out in the public, which makes their earnings per share numbers maybe better than they really are. There's two numbers when you listen to what's happening, say on a CNBC or something. There's a revenue. You know, they've had, they hit the revenue number. Okay, that's good. And then they hit their earnings per share number, which is a really easier number to manipulate. You know, if you think this is what came in the door, revenues, it's hard to mess that one up. but the earnings per share is in part due to the fact of how many shares are out there. If we are buying back stock, there's less out there to work with. And so the earnings for every one of those shares that's actually out in the public is what they're actually using as their EPS number. So harder to predict, harder to understand. I don't want to blow you up with this, but I want you to understand that things have started to slow down. If you look at the real estate market, freaking on fire. I hate to say it that way, but it's been insane. But we're starting to hear that we may have at least seen the top from here. So just be aware that, you know, at some point you might actually see the real estate market start to slow down a little bit. So this is a REIT index. This is Fidelity's Morgan Stanley Citigroup Index Real Estate Index, and you can see marching up pretty great, and now starting to waffle a little bit. This is called a consolidation pattern there. So is it bad? No, it's great, but it's really no better than it was back September if you're trying to draw a line across here and say, is the real estate market advancing or is it kind of leveled off? So just pay attention to the canaries in the coal mine and be aware with your own portfolio. Gold. A lot of people buy gold because they're afraid. I mean, I'm just telling you, it's a fear purchase. So gold spiked over here. That was 2020. That's easy to figure. COVID made it run up. People said, okay, the stock market's going up. So again, it just didn't do anything. And then we had wars, rumors of wars, and all that other stuff. And gold spiked, but now it's kind of doing the same thing that gold typically does. So not a safe haven. I don't do Bitcoin, but I can show you gray scale Bitcoin, which is a way to buy it. And you can see Bitcoin really did its thing up until about February of 2021. And then it's just been chopping and churning and really hasn't done a whole lot since then. So everything has its day, and maybe we're just due for a little bit of a repricing. And so not a panic type of comment to you, just saying that be aware that it's not like it was unless they start trying to print some more money. So I'm going to let you go for now. I want you to have a great April, and we will talk to you next month.